Dear viewers, investor community always looks out for the possibilities of increasing the return on their investment. Saving on the taxes is the simplest and very efficient way to increase returns on your investment portfolio. In this episode, I am going to talk to you about how you can manage your taxes for a better return when you do the investments. This is NRI Money Clinic for you, and I am Dr. Chandrakant Bhatt, your financial guide for a happy living.
NRI Money Clinic. No hype, just the right advice.
Dear viewers, who doesn't like a better return on their investment portfolio? Everybody likes it. Who likes to pay taxes? No one likes to pay taxes. But the reality is that taxes are here to stay. You can't avoid them, but you can manage them. Let us see how you can manage your taxes to get a better return on your investment portfolio. There are three possible ways by which you can manage taxes or reduce the tax impact. What are these three methods? 1. Completely avoiding the taxes using all possible avenues. 2. Reducing your tax slab or reducing your tax impact on the incomes that you derive. 3. By postponing your taxation, how you can efficiently use this money to generate a better return. These are the three possible ways where you can manage your taxes. Let us look at all these a little bit in detail, point by point. Now let us look at how you can avoid the taxes. There was a time you had so many options in front of you. For example, before 2018, the mutual fund gains were completely tax-free. Whether you are getting a dividend or whether you are getting a capital gains, they were completely tax-free. Likewise, the BPF accounts, they were completely tax-free. You had the unit-linked insurance plans, they were completely tax-free. Your gains from the stock markets were also tax-free. This was prior to 2018 when it comes to question of mutual funds and the equity. From 2020 onwards, even the gains from ULIPs and BPF became taxable. Of course, government has given some relaxation there up to 2.5 lakh per year, that is a tax-free amount. Now, using all the provisions that is given by the government, you can reduce taxes to the possible extent. See, for example, in case of mutual funds today, you have up to 1 lakh exemptions on the capital gains tax. By doing a tax harvesting, probably the amount of taxes that is applicable for that can be removed from your taxation. Likewise, putting up to 2.5 lakh in a ULIP plans can also give you a tax break. You can also use the limits which are given under BPF to avoid the taxes. PPF is one segment where up to 1.5 lakh you can put per year, which will completely exempt taxes. So use all means which are given by the government, use all those investments where you have a tax exemptions given to you, thereby you can avoid the taxes. The second question is, how can I manage taxes? By reducing the tax slab. See, if your income is categorized under income tax, it will follow a slab rate, 10%, 20%, 30%, cess, surcharge, all put together. Your taxes can go up all the way up to 39, 40, 42.5% in some cases. Now, there is a possibility by intelligently positioning your investments in an instrument which will bypass the income tax but rather attracts capital gains tax, you can reduce your tax slab. One classic example could be, see, now if you have got the bank fixed deposit. In case of bank fixed deposit, what happens? The interest that you derive from the bank fixed deposit will come under the income tax. At the end of the year, you have to take a certificate from the bank. So much is the interest that is earned, it is added to your income, and if you are in a higher tax slab, then you have to pay taxes accordingly on the interest income that you derive. Now let us look at if this is moved into a capital gains tax regime. How you can do that? Probably you can use the debt funds of the mutual fund and you move your fixed deposits into the debt funds, then it will bypass the income tax, comes under the capital gains tax. What is the advantage under the capital gains tax? The capital gains tax is a deferred taxation. In case of income tax, you have to pay taxes every year, whether you draw that money or not. Whereas in case of a capital gains tax, you pay capital gains tax only when you sell your asset. Let's say that you put it in a debt fund or whichever the portfolio you prepare in a mutual fund, and you don't sell it for next 3 years, 5 years, 10 years, 15 years, 25 years, 30 years. As long as you don't sell it, it will not suffer taxation. When you sell, it is treated as a capital gains tax. The capital gains tax structure is much lower than the income tax. The long-term capital gains on an equity portfolio is just 10%. In case of debt funds, the taxation has an indexation benefit. So approximately, again, the tax slab drops to about 10% or so. So by moving your instrument, which attracts income tax, into a regime which attracts capital gains tax, there is a possibility for you to greatly reduce your tax outgo. This will easily help you get a post-tax return which is far better. In case of NRIs, they have got two types of bank accounts. They have got an NRO account and there are NRE accounts. Many of the NRIs do not know the difference between an NRE FD and an NRO FD. They simply maintain NRO bank account. Reason is because they had an SB account before they went abroad. They just got it converted into NRO. They are sending money into this and they are maintaining an NRO FD. A simple system of remitting money into your NRE account and maintaining NRE FDs will completely make it tax free. With ignorance, if you maintain fixed deposits in NRO bank accounts and create NRO FDs, you are unnecessarily inviting taxation. The next possible way how you can reduce your taxation is by making best use of all provisions given to you by the government. You can invest in ELSS funds, you can invest in insurance policies, you can pay health insurance premium. Under each of these categories, there is a provision for you to reduce your taxation. See, under ATC, you have got a provision to invest up to 1.5 lakh per year, and to that extent your income is reduced. Of course, it is different instruments are put in the place there. The limit is across all these things. It is not for each one of them. Like you can put it on a PPF account or you can put it on an insurance premium account. All aggregate put together, it will be 1.5 lakh. There is also a provision under National Pension Scheme. You can invest up to 50,000 rupees over and above this 1.5 lakh limit which is given in ATC. That will also save a tax burden for you. Make best use of all provision which is given in the Act to bring down your tax incidence. In case of mutual fund, long-term gains from the equity mutual funds has an exemption of 1 lakh rupee capital gains per year. By doing a tax harvesting, every year you can claim the exemptions which is given to you. This will also reduce your taxation. One another way to reduce your taxes is converting your dividend option in a mutual fund to an SWP option. There was a time where the dividends were tax-free if it was given by the mutual funds. But now the recent changes, if you receive dividends from the mutual fund, it is taxable. Instead of receiving dividends from the mutual fund, keep your monies in the growth options, and to the extent of monies you need every year, you can use the SWP, systematic withdrawal option. Thereby, instead of the dividends coming under the income tax, you can shift this to capital gains by doing the SWP. This will definitely reduce your tax incidence. NRIs live in different countries. They have one another provision to reduce the taxes, that is double tax avoidance agreement. We have done detailed videos on double tax avoidance agreement, how you can save on the capital gains tax that you can pay in India using the DTAA provision. Please check through the DTA agreements between India and the country in which you live. Whatever the provisions that have been given to you under that law, you are entitled to use that and bring down your taxation. The third method by which you can manage taxes is by postponing your payment of tax. If I pay the taxes today, then the amount which I have to reinvest comes down to the extent of taxes that I have paid. Imagine a situation, you don't pay the taxes today. Instead, you pay these taxes at a future point, 3 years, 5 years, 10 years, 15 years. Then the taxes that you have saved can compound itself and you will be paying the taxes in future. This will also increase your return on your investment. A case in point again is taxable bank fixed deposits. In case of bank fixed deposit, your interest is treated as income of the year and you are liable to pay taxes that year itself. So the amount after paying the taxes will be reinvested. But if this comes under the capital gains tax, till you sell for whatever the period you are going to hold, it will not suffer taxation. In the first case of bank fixed deposits, you are liable to pay taxes immediate that year itself, and you are left with lesser amount to reinvest. In case of capital gains tax, what happens is you pay the capital gains tax only at a future point when you sell your asset. By intelligently holding on to those assets, you maximize your return. And as I already told, capital gains tax will also have lesser tax slab compared to the income tax. Dear viewers, I have a question for you. I have mentioned that there are investments where you can pay deferred taxation, which will come under capital gains tax. My question to you is, please let me know which other instruments which you have used which have got deferred taxation. I'll be waiting for your answers. Leave your answers in the comment section below. Dear viewers, I am a practitioner of finance. We understand the taxation angle very, very well. We have helped thousands of families across globe in managing their investment in a very tax efficient way. If you are a person who is looking out for professional services to manage your funds in a tax efficient way, you can make best use of our services. How can you reach to us? Simple. We have shown our number here on the screens. Through a WhatsApp message from any corner of the world, you can send that message, and one of the financial guides who is working with us, or maybe myself, could be the persons who will be helping you to build investment portfolios which will have tax efficiency. Do not delay, send that message now. Dear viewers, hope the video that I have done today helped you to understand how you can manage your taxes and bring down the tax incidence by intelligent mixture of avoiding taxes or reducing the slab or postponing your taxes. If it did help you to understand the finer points of the taxation here, please like this video. If you are a person who is watching this channel for the first time, or if you are yet to subscribe for my channel, please hit the subscribe button and press the bell icon. Don't forget to share this video with your near and dear ones. Thank you very much for watching this episode on NRI Money Clinic. I shall be back with you with yet another topic in yet another video very, very soon.
Press the bell icon for more details and subscribe our channel.